Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
I'm going to get to these markets here. The story's been, it feels to this simple investor over here that the interest rates out there in the marketplace have really been impacting stocks, and that's just my take. Vince Cignarella, he joins us. He's a pro, global macro strategist for Bloomberg News. New knee or just a repaired knee?
Replacement.
Partial
replacement.
Partial replacement knee. He's walking just fine. He found his way into the Bloomberg Interactive Broker studio. We left some crumbs out for him. Vince, what do you make of these markets here?
The equity market's looking really sick. I mean, if you look at longer-term charts,
sick as in bad, like not what the kids say. Sick,
not cool sick.
It's looking
exactly.
ill.
Yes,
not like Beastie Boys ill, but like unwell.
Unwell.
Yes.
There's a level to watch at around 4150. It's a TD sequential level. If that breaks, it actually opens up a major move down to 4,000. We're looking at a potential major move lower in equity markets if these levels don't hold, and we're going to need to see some help from probably Amazon and the like going forward to lift this higher, because it's not going to come from interest rates.
Well, Abigail Doolittle yesterday showed me. Oh, you're looking at that. No, not RSI.
No,
I don't buy that.
That is awesome. Look at the RSI for SPX. We are right there. You buy them right here, unless, as you say, it breaks through that little green line. See, I like the colors and everything.
Give me a break.
If it goes
I'll tell you what, though, it did move below the 200. The S&P moved below the 200-day moving average, and the last time we've seen it that low, in those terms, was March when SVB.
And it's well below the 200-day, which is around 42.35. So we're well below that. So 41.70, interestingly enough, is the average closing price for the last year. So between this 41.50, 41.70 level, I'd love to see it hold and maybe catch a bid. But so far, it's looking a little bit of a dead cat bounce here.
If I see rates up, as Paul said, rates have been a huge driver, I feel like. If I see rates up, if I see dollar strength, if I see oil up, that's all bad for equities, right?
Yeah. And you know what? Rates aren't really, there's not much of an impetus for rates to go substantially lower. We need to see really super low inflation numbers to turn rates. At the moment, we're seeing a little bit of a reprieve in the Treasury market. Ackman's trade helped it a little bit. It got some algo.
Americans want to buy Treasuries, but who else?
Pretty much. There
Chinese,
you go.
Japanese, foreign buyers, they don't want to hold this paper.
No.
Yeah.
Why not?
Well,
what else are you going to buy?
That's actually a good point, though. But the upside for it, you're just buying it for yield. You're not looking at it for capital.
Well, it's the first time in almost a generation you could get yield.
Oh, no. I mean, a lot of people are loving it. You're looking at CDs at 5.5%. I mean, these are great rates, especially for fixed income or seniors on a fixed income. A lot of folks out there doing that. I mean, I've done a little bit myself. I'm kind of a senior, actually, these days. But, I could see rates staying here. Not really going down a lot, not really going up a lot, but that's not going to help the equity market. It's going to need it from somewhere else.
So when a guy like Bill Ackman says, I closed my short in the Treasury markets, does that mean anything to pros out there, or is that just a name? No.
And if you think about it, the size of his fund, it was like a 1% gain. So
he was out long, too, right? Wasn't he talking about the 30-year?
Yeah.
Yeah.
Yeah, but he had a 1% gain on the assets under management. I mean,
he wasn't the only Bill. Bill Gross also.
What is he, long or short?
He's going long Treasuries now.
Well, so is Warren Buffett. Warren
closing
Buffett
it short at least.
Yeah. Okay.
Yeah, they put a position on Monday and tell you on Wednesday what they did, so you'll join in and
By
get
the way,
them into the money.
Do those names? The other day, our producer Eric Molo, he had a mask on, and I said, "Hey, dude, where's Tonto?" And he had no idea what I was talking about. And I said, "You know what? Like the Lone Ranger," and he was like, "No, sorry, don't get it." He did not know who the Lone Ranger was. And do these kids today? Do they know Bill Gross? Do they know Warren Buffett, like in a real way? Or?
I mean, the algo programmers do, because they take those names and they program it into their trading venues. But actually, the only iconic name from that era that is actually incredibly well known, Lassie. Everyone knows who Lassie is.
This is not in the markets.
No.
Yes.
Yeah. Well, in the world in general.
world.
Yeah, markets too. I mean, all the years I
Do
traded.
you think Eric Molo knows who Lassie was?
I think so. We'll have to test them on the way out.
Check them out. All right, what's the most interesting trade for you out there just in the markets? I know you look at currency, stocks, bonds, all kinds of stuff out there. What are you looking at?
To me, going back to interest rates, I still like the short term. I still like two-year treasuries. I mean, that's the one that's really going to catch a bid when the Fed decides to turn or the Fed says, I stopped, because you would more likely than not see the yield curve steepen if inflation expectations remain. That's not going to affect the short end as much. So if you see steepening, it's going to be a sell-off in the back end. I think the short end is the place to be because inevitably that's got to come your way. The Fed.
Matt's been telling me not to crowd into that 2-year because I'm going to have interest rate risk.
Reinvestment risk.
Now the 30-year, 5.07. You were right. Now you can buy 30
Well, I'm not
years
saying,
and get 5%.
first of all, I don't give investment advice.
I loaded up on that.
And if I
trade.
do, you should run the other direction. But no, I'm not saying you want duration right now. I'm just, I just look at the the reinvestment risk as something that is better dealt with by, you have like very sophisticated investment advisors. I just look at an ETF. I would rather T-bill and chill,
T-bill and chill. I get Yankee tickets, and you do T-bill and chill. All right, so what are we doing here, Vince? I mean, is the next move for this Federal Reserve to just stay or to still talk tough? We heard Christine Lagarde, ECB today, still talking tough.
I take that with a grain of salt. They're saying what they have to say. I mean, Lagarde's been, if you go back 10 years when inflation in the Eurozone was below 1%, all you heard from the ECB central bankers was HICP inflation is moving towards target. It didn't move for 5 years, but they said that at every meeting. So now at every meeting, they're going to say we can still raise, but they have no real intention of raising. Neither does the Fed, I think. I mean, the Fed will talk a tough book, potentially raising one more. I have absolutely no idea why. There's really no reason to raise at this point.
Inflation isn't moving down quickly enough.
Yeah, well, what's
they
quickly
need to counter
enough?
Fiscal spending. I mean, it needs to be 2, like last week.
But I would argue this: the idea of getting inflation to 2% goal is ridiculous. The 2% goal was at a time when there was a balance sheet of $1 trillion. Now we have a federal deficit of $33 trillion. The balance sheet at the Fed is off the charts. You're not going to see 2% inflation. You're going to see 2% inflation if you have a disaster.
Well, you don't think they're going to get there?
No. I think that if they're lucky, they get to 3.5, and they should be happy if they do so.
I'm in that camp. I don't know what's so special about 2%.
They made it up.
Yeah, that's what I feel.
It's literally they just made it up.
They would all be made up, but the point is inflation is just thievery, right? You're just robbing from savers. So it's their duty to get it down to near as damn it to zero, I would say.
Well, I mean, you're robbing savers if you don't have real interest rates higher, but we now have real interest rates starting to come to the positive. If you get inflation down to 3.5%, you're not going to see a 10-year yield of 3%, so you're still going to have a positive carry, and people are going to be earning. I mean, the other side of the coin is you get inflation at 3.5%. Where does that put the S&P? Probably around 4,800. So you're going to have a positive return somewhere. It's just a matter of where you go.
All right. What do we do? I mean, all right. I think my Fed's going to stay put next time.
I think so too, and I think I look at tech, and I'm always the one where I joke with people and say you're not going to get your next iPhone from Campbell's Soup. So, whatever they're selling, whenever they sell tech this aggressively, to me it looks like an opportunity to layer in.
So you want to buy the big tech?
I would buy the big tech, but just get my feet wet here and there, my toes wet.
I don't think I'm buying the iPhone 15. My daughter, I looked at it yesterday. It's got a new plug. So you got to replace all your plugs.
Yeah, but it's USB-C, so it's like much more universal.
I got my plugs strategically located everywhere. None is more than an arm length away.
Dude, I feel
now
you.
I got to replace everything.
I feel you.
That in and of itself
you
is
can
going to hurt
blame
the
the
replacement
Europeans for
cycle.
that because they made Apple abide by their
that was
their
a
standards.
regulation move. But
Yeah.
I'm happy they finally got to it. But you're right, we have to buy all new cables, and it's a risk.
All right, Vince Cignarella, thank you so much. We appreciate it.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
I want to get to the end of the strike. I mean, I want to get to it. I'm sure the union members want to get to it. I know the car makers want to get to it. Let's talk on the telephone, on Zoom, actually, with Keith Naughton. He covers...
Really, on Zoom? Look at him going all technical.
Ford and the Big Three for us out of Motor City. And it looks like at least Ford has got a tentative agreement with the UAW. Keith, walk us through it.
Yeah, so it's an agreement that includes a 25% raise and the restoration of cost of living allowances, those two combined mean that the actual pay increase for the top wage earners is actually 33%, and means they'll be making over $40 an hour. There's improvements, especially for new workers. They're getting even larger raises. Temp workers are being converted to full-time. They're doing increasing the multiplier on pensions and 401ks. So there's a whole bunch of good economic enhancements that are in the agreement.
Now you use the word pensions, Keith. I imagine you're talking about people who already had pensions who have been working there since pre-2007, because I know that Sean Fain, he wanted a pay increase. He also wanted pensions for all the union workers, defined benefit pensions, and he wanted a 4-day work week or a 32-hour work week. So did he get 2 out of 3?
Yeah,
or just 1 out of,
if you want to talk about
3?
the stuff he didn't get, Matt, he did not get the 32-hour work week or the 4-day work week. He did not get a return to traditional pensions. What he got instead is a larger contribution from the company to your 401k or to your pension. All those before, as you said, 2007, do have traditional pensions. So it's the workers hired in the last 15 years that don't. So they instead are going to have a greater contribution, greater multiplier.
All right, Keith.
So,
I'm guessing this puts the pressure really on GM and Stellantis. How does this play out from here?
Yeah, I mean, so the analysts are already crunching the numbers, and the Emmanuel Rosner over at Deutsche Bank is saying that this would cost Ford $6.2 billion over the life of the contract, but it actually would cost GM and Stellantis more. GM would be over $7 billion, Stellantis higher in the $6 billions, because they have more temporary workers. So there's more temps to give raises to. There's more temps to convert to full time. So by going first, Ford was able to tailor the agreement to their specific situation. They only have 2 to 3% of the workforce that is temps, whereas GM and Stellantis GM's closer to 10, and Stellantis is over 10.
Interesting.
So does this mean? Ford workers are going to go back to the Kentucky plant. They're going to start building the Bronco again in Dearborn. They're going to put the pressure, in that sense, further pressure on GM and Stellantis. Do you expect agreements from the other two by the end of the day?
I don't, actually. I think there's still work to be done, and that's an important point that you just made, Matt, because back in 2019, when the UAW struck GM, when they reached a tentative agreement, the workers did not go back to the plants. They didn't open the plants again until after that agreement had been ratified by the full membership, which took weeks. But in this case, the UAW is sending the workers at Ford back to the plants immediately. The plants are cranking up today because they want to put pressure on GM and Stellantis. The losses for each of those companies just from this strike are approaching $1 billion. So, and just this week, the two of them, GM and Stellantis, had their most profitable plants go out on strike. So the costs are going to escalate more rapidly now.
All right.
So
catch us up, Keith. Catch us up on who's. So the Bronco is made at the truck assembly plant, right? In Wayne, Michigan, actually.
Yeah. So what's coming back online? Is that what you're asking me at?
What's still off? Because I know on Tuesday they struck the GM plant that makes like the Escalade and the Tahoe, right? At least one of them.
Right. Yep. Yeah. At GM, the big plant struck this week is the Arlington, Texas plant that makes all the big SUVs: Suburban, Tahoe, Yukon, and Escalade. And at Stellantis this week, it was the Ram pickup truck plant in Sterling Heights, Michigan, and that is their most profitable plant. For Ford, the ones coming back are the Bronco and the Ranger plant. That was the one that went down immediately. The one that was more recently taken down on October 11th is Kentucky Truck, that makes the biggest F-Series trucks and the biggest SUVs, the Lincoln Navigator and the Ford Expedition.
Hey, Keith,
the Super Duties.
25% seems like a lot to me, even though it's over a number of years. What are the auto companies getting here?
Well, they're getting labor peace, which, costs something. but they're getting richer contracts, and they already had the highest labor costs, in the industry. So what GM said, Mary Barra, the CEO of GM, said during their earnings call this week, is they're going to try and find offset. They're going to try and do cost cuts to, make up for this. But it's these are expensive deals, and they're going to have to find a way to get their costs competitive.
That makes me worry about the vehicles. Ouch! You're going to start putting in like lower quality parts. That's what I worry about. That's what everyone who's buying these cars and trucks, Keith. I spend a lot of time on the forums, right? Of many different brands, and they're all like, "Oh, stay away from that company because they're going to strike." And even if they didn't strike, maybe they will, and workers are going to be unhappy and not do as good a job. Right. Yeah, but if they cut costs, does that mean we're going to have lower quality components?
Not necessarily. I mean, in companies as large as these, there's all kinds of waste and redundancy that you can work on. I mean, they cut by the billions when they're cutting costs. And obviously people is one of the ways they cut costs. Let's not forget, Jim Farley said just a year ago that Ford had 25% more engineers than its competitors. He's been cutting salaried staff by the thousands. So, there's still probably people that he will cut as they continue to move into their EV future from their internal combustion engine present.
So I know, Keith, for the unions, one of the asks or demands was something nebulous to me, at least, which is, hey, can you guarantee we're going to still have the same number of positions in an EV world that we have in an ICE world? Did they get any language to that effect?
There is some job security in this, and Ford had told them that they would not lay off anyone during the term of this contract, which is 4 years and 8 months.
Okay.
And in fact, would add to workers. But it's not an idle concern by the union. It takes 40% less labor to assemble the powertrain of an electric vehicle than it does an internal combustion engine vehicle, which has thousands of parts versus about 20 in an electric vehicle. So, that is coming, and they got to figure out how that's all going to work out.
What do you think this deal looks like to non-union shops, Keith? I think of the BMW plant in Spartanburg or the Tesla plants.
Is that where my X3 was made?
Your X3 was made in Spartanburg. Yes, okay. In fact, it was.
Very good.
Very cool plant and cool truck. I like it a lot. But what do you think about those shops? Are they going to look at this deal and say, we should have a union too. We should be in the UAW.
That is what the UAW is counting on. So it depends on, when you say what does it mean for those plants, it depends on who you're talking about. If you're talking about the companies themselves, the CEOs, I think what it means to them is the price of poker just went up. And the way they've kept unions out of their plants is they've offered, equivalent wages and benefits. So if the CEOs want to keep the unions out of their plants, they're going to have to give everybody a raise at those non-union plants. If they don't, the UAW has a big opening to go in and organize them.
All right, very good. Keith Naughton, thanks so much. We appreciate that. Keith Naughton, he is a reporter for Bloomberg News in Detroit. He is our go-to voice there. And again, we get a deal from Ford, and presumably, Matt, that means Stellantis and GM, a little pressure on them to get something done because Ford is back out cranking out the trucks here.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Welcome to our Bloomberg television and radio audiences. I'm standing by now with Morgan Stanley CEO and Chairman James Gorman and incoming CEO Ted Pick. Big moment for Morgan Stanley, 14 years at the helm. How does it feel to be passing on the baton?
Feels great. For several reasons. One, it's time. Organizations grow because you have change. I mean, you're not going to grow by doing the same thing again and again. And I feel like we set this up several years ago with the board. We've had a very, very intentional process, and we ended up with a phenomenal outcome, which is Ted. And we've got other unbelievably good executives who are taking leadership roles as co-presidents, Andy Saperstein and Dan Simkwitz. So it's sort of what you hope for. I mean, you try and drive strategy, you try and put together a team, You try and deal with the inevitable knocks that you get from the market and the disappointments that come in times in any complex business. But at the end of the day, you're also trying to hand it off for the next generation. So it feels great, and it feels right.
You've been rumored to be a CEO contender for oh so long, Ted. How does it finally feel to step into the role next year?
Sonali, Morgan Stanley was the first place that I worked out of college. And 33 years later, I'm sitting next to Mr. James Gorman. It's the thrill of a lifetime. I'm so excited.
Now, you've really inherited a gift here, a massive transformation over 14 years, one of the best valuations here in global banking. But there are investors who are worried this is as good as it gets. What do you tell them?
There's more to come. There's more to come. We look at the 5-year chart, the 10-year chart, the 15-year chart. The wealth and asset management businesses have these remarkable durable earnings. The global investment bank has lots of miles to go. So we're thrilled about the business strategy we have in place, and it's going to continue to deliver long-term value for shareholders.
Now, for both of you, we've been in such a prolonged bull market that has hit such volatile times as of late. Do you expect the next couple of years for Morgan Stanley to be a little more choppy?
You know, I don't know. It's I thought this year would be tough, and it was. A lot of what's going in the market conspires against our particular business mix. Some of the more commercial retail banks, mortgage banks, very different business model. But our turn will come. I think, you know, I personally think the U.S. has dodged a recession. I think the Fed is very close to being final, within probably 25 basis points. We're starting to see activity. Look at the Chevron deal we just announced the other day. I mean, phenomenal. So we're seeing activity in different sectors. It's coming alive now. So no, I think the next couple of years will be great. But what I care about is over the really long run. When we set about on this journey, we weren't focused on a quarter. And if the stock takes a dip in a quarter, I say that's kind of good news because we're buying back stock. And every share you buy back, you're retiring a dividend. So shareholders who hang tough are getting a 4.5% yield, and we're buying back stock, and the stock's cheap. So it's kind of a good situation to be in. But medium term, no, I think the firm is going to do great.
Ted, what are the biggest challenges for you as you navigate this environment?
There's just so much opportunity. We're definitely in a new paradigm. Interest rates are going to be higher for longer, and the world's gotten smaller, which means the clients need advice. They need it in the wealth and asset management space. They need it in the institutional space, our corporate clients, and we're going to have lots of activity around those clients. So I just want to make sure that we are completely aligned in the business strategy we have in place. It's something that James has painstakingly put together for 14 years. The market knows what we want to do. So I'm incredibly optimistic over the next couple of years.
Now, a lot of lessons have been learned in this building over the last several decades, really. What to do, what not to do. What is the Morgan Stanley playbook of what not to do in 2024 as you navigate this new environment?
Well, I think it's to continue to do what we've been doing, which is to treat each other with respect. This process that James and the board ran was intentional. It was respectful. I couldn't be more thrilled to be working with Andy Saperstein and Dan Simkowitz, two of my closest friends. They are extraordinary leaders. They're going to drive these businesses. The fact that we've worked so collegially, this is the kind of Morgan Stanley that we've known and loved, the blue Morgan Stanley of respect and focusing on clients. And during this painstaking process, there's been no loss of focus. We've been focused on our shareholders, on our clients, and the fact that today we had a celebration with our partners, and it was really quite a wonderful experience, shows that we are on the ball and sticking with the future.
I'm glad you mentioned Andy and Dan because a lot of questions here around, they were two CEO candidates. Now they're going to be the co-presidents. How do you keep them around? Are you holding them to any lockup periods?
No, they've got phenomenal job opportunities. Andy's co-president. He's now running not just wealth management, which included E-Trade, but asset management, which includes Eaton Vance. So he's overseen the biggest wealth and asset manager in the world at what I believe is the most prestigious and best investment bank in the world. Dan came out of capital markets and is now going back there after a great stint running asset management. And he's going to be running all of global trading, banking, capital markets, his old home turf, research. And most importantly, the two of them are going to work with Ted in helping to manage the firm. So, no, these are phenomenal opportunities. They're high quality people. These are some of the best jobs on the planet, and we're delighted to have them.
Now, I'm glad you brought up the institutional securities business. That is your old home as you move to the new spot. But what's interesting, you've long been the number one in equities trading. Lately, Goldman has surpassed Morgan Stanley in a couple of quarters, while JP Morgan and Goldman have been faring better in various forms of M&A and underwriting. Do you have a plan to be number one again?
Listen, we have some great competitors, as you know, in the global investment bank, in equities and fixed income, and then across investment banking. We're focused on being number one. We want to have the right people in place. We've been investing for the next cycle. That next cycle is going to be investment banking led. And it means that in equities, we want to be one or two every quarter as we have been for the last decade. We have a fixed income business we restructured. It's now a top 5 business. And investment banking is going to lead the next cycle. There's going to be a lot of M&A consolidation. It's going to be across industry groups. The world's gotten smaller. There's a new cost of capital. We want to be a leader, a global leader in all those spaces.
Now, James has hinted before to the possibility of more mergers and acquisitions for Morgan Stanley moving forward. You've already done some very transformative ones. Do you feel, Ted, that it's a matter of time in the CEO seat before you can do a significant deal? Or do you feel like you can jump right in?
Well, I think we now have done 3 major acquisitions over the last 15 years, all of which were in James's vision. Smith Barney shortly after the financial crisis, E-Trade at the dawn of the pandemic, and then Eaton Vance. Those are 3 major integrations. We like what we have. The business strategy's in place. Let's execute on what we have, keep the strategy in place. We always talk about acquisition candidates, but that's off into the future.
Now, the other thing, James has said that there were a few things you'd rather get out of the way before stepping down, including the U.S. investigation into Morgan Stanley's role into the block trading market. Is this something that can be resolved before you step down?
Well, I'm going to stay, as you know, Sonali, as executive chairman for a period of time. We'll see how long. Frankly, I shouldn't stay too long because it's Ted's job to run the firm now. So I'm going to be there just to help him in whatever way and obviously meet with regulators around the globe who I've got to know over the last decade plus and key clients. And also in that period, there are a few things I want to still clean up. I want to hand, I said, as clean a plate as possible. These are monster jobs and enormously complex. You travel a lot. There's a lot that comes at you. So I think it's nice to start with a clean plate. We wouldn't have announced I was stepping down if we didn't think whatever we still have left isn't manageable. I mean, I wanted to see CCAR through. We came out of that actually with a better capital ratio than we went into it. 12.9 CET1 requirement. We're at 15.5. I wanted to see the initial Basel proposal. We've seen that. I don't think it will end up where it is, and we're working very closely with regulators. I wanted to see the sort of summer months. Obviously, a difficult quarter. We knew that was coming. So I wanted to just see the firm through that and then through this transitional leadership. So, no, we're very comfortable with where we are in the process, and I'll do everything I can to help Ted and help Dan and Andy.
Now, one large issue that has been plaguing Wall Street is the lack of gender and ethnic diversity at the top ranks. And when this CEO search had come to its final steps, there were no women or people of color that were considered for the CEO ranks. What is your plan to increase representation in the top ranks of Morgan Stanley?
The next generation has lots of representation of all types. It's a priority. It'll continue to be a priority.
Do you have specific goals over the next few years to make sure that's, the
well,
next set of CEOs?
Sonali, it's a good question. We run a meritocracy, and diversity comes in all types. And we have fantastic women and men from all backgrounds in senior positions on operating committees throughout the firm. And I couldn't be more excited about the look of the firm in the next 5-10 years.
Now, I know you've said also that, largely the strategy is in place and it will be continued on into the new leadership. There is one thing that is very much in the mind of CEOs lately, and that's technological disruption happening at a rapid clip. How are you thinking about how this could change Morgan Stanley and its positioning in the future? Well,
Walter Wriston said it best. He said the most, I don't think he was totally right on this, but he observed the most important technological evolution for the financial services industry was the ATM machine. And each generation, if you look at it, has embraced technology into the businesses to make them better. What Ted did with the electronic trading and equities, so-called MSET, phenomenal. And that basically fed all of our trading apparatus that has supported that business being, again, number 1 or 2, depending on the quarter, but right up there. what we've done with E-Trade. E-Trade's a technology company with a brand. What we did with ShareWorks and what is now Morgan Stanley work, the electronic stock plan business. And Solim, we bought. Solim's a company of programmers in Calgary, Canada, and that became the birth of the stock plan business. So there's always technological revolution. What Andy Saperstein is now doing in the AI space, sort of building off the early machine learning we did to create virtual financial advisors. It's endless. We just had a presentation of the board on it. So it's in everything we do. We have nearly 20,000 employees, direct or consultants, working for us in technology now.
Before I let you guys go, what is the one biggest piece of advice that you have to Ted as you pass over the reins?
Enjoy it. It's an incredible privilege to be able to make the call, to make decisions. Sometimes you'll be wrong. The only way to be right is not to make any. So I took the approach of, I was looking for, I don't know what the analogy is, something at bats, so I'm not really a baseball player, but I wanted to make enough decisions where we got a lot of things right. And along the way, a few things mightn't go your way, but that's okay. Just enjoy the journey, embrace the good bits and the bad bits, as Kipling said in If, and those imposters of success and failure. And, keep yourself focused on the long term. You're going to have great quarters and you're going to have disappointing quarters. You're going to think the stock should be up when it's down and down when it's up. None of that matters. What matters is the long-term health of the franchise, the values, and your own stability in that role. And part of that is building a team. He's off to a phenomenal start in 24 hours. He got a standing ovation from the board last night. We had a wonderful dinner with directors. We had all partners live in this building today and broadcast around to our 83,000 employees. So, enjoy the moment. It's an incredible privilege.
Ted, James, it was a pleasure to spend time with you on such a landmark day for Morgan Stanley, and hope to see you at the turn of the year when you take your new job.
Thank you so much.
Thanks, Sonali.
You're listening to The Tape, Kantar Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Let's turn our heads to Washington, D.C. Why? Because we kind of have to. Jen Flitton, she is head of U.S. Government Affairs at Invesco, joins us. So, Jen, we actually have a Speaker of the House now. I guess that's a good thing. What are you taking away from, I know you're based down in Washington, what are you taking away from the last couple of days of what we've seen in the House?
Yeah, well, it's been particularly difficult for House Republicans. It's been a rather embarrassing 22 days. And so I think a series of frustrations and bloodletting in the family meetings finally resulted in complete exhaustion. And Mike Johnson, who is a fairly well-liked member of Congress, although relatively unknown outside of Washington, there was unanimous support. So I think he came in at the right time. And I think a lot is going to be said for his ability to move forward. Hopefully he'll be able to take that unanimous support and move it into the legislative
So does
sphere.
this mean that Donald Trump is now back to holding the most sway of the Republican Party? Because what we do know Mike Johnson for is leading the way on that amicus brief to overturn the election results. Mike Johnson is an election denier. He doesn't believe that American democracy worked in 2020. He doesn't believe that President Biden fairly won the election. And all of the people in his party supported a person like that for Speaker of the House. Does that mean, well, either none of them believe in the U.S. democracy or they're all sort of heeding the Trumpian call?
Well, first I'll say Donald Trump is the de facto leader of the Republican Party. There is no doubt about that. He is the former president. He's running for re-election, right? And he is the leading candidate in the primary. So, there's little doubt that Donald Trump is the leader of the Republican Party. That being said, he did have some sort of force within the last 22 days, putting in his support first for Jordan, who failed, quite frankly, then opposition to Tom Emmer, who had already had about 26 votes against him already. So whether that sank him or whether that sort of sealed the deal, I think is sort of an open question. But moving forward, into 2024, into an election year, I have no doubt that this Republican conference will be united behind whoever is the Republican primary candidate. And right now, Donald Trump is taking a heavy lead there.
All right, so where does the Republican Party go now? Where does the House go now from a legislative perspective?
Well, two things, right? So first, they have to get appropriations bills across the House floor. And they need their appropriations bills because they are marking to FY22 levels. The Senate is marking to FY23 levels. That is a big disagreement, right? So over the next several weeks, you're going to see the House Republicans moving the House appropriations bills across the table. That will be quite a feat on some of these bills, which are rather controversial, to keep that Republican majority united, because they only have a 4-vote margin. They can only lose 4 or 5 votes depending on the day, depending on how many members are in town. And so that will put them in the negotiating position that they'll need to have in order to negotiate with the Senate on government funding going forward. And then, of course, there is the defense supplemental that the White House sent to the Senate last week. It's currently being debated, discussed through hearings, through regular process in the Senate. I expect the same to happen in the House, but that's going to take a little bit of time. And that's funding Israel, Ukraine, Indo-Pacific, the border, and there are going to be a lot of disagreements, a lot of controversies around the policy that surrounds that money.
In terms of cutting spending, is there any hope that these Republicans are going to be able to rein it in after we've seen, basically deficits since Bill Clinton? Say what you will about the philandering of William Jefferson Clinton. At least he balanced the budget, right? Is there any hope that something like that happens ever again in our lifetimes, Jen?
That's right. And Bill Clinton came together with House Republicans, with Newt Gingrich, and was able to do that really in a bipartisan way. I don't necessarily see that sort of work being done between the White House and this Republican conference in the House. I do think, though, we will see it's going to naturally happen because of the debt ceiling deal, the parameters set forth. Either there is a 1% cut across the board starting January 1st, or they are able to come to some sort of agreement on appropriations that is going to lower the levels of spending. Because you're right, we're facing a $33 trillion national debt, over $1 billion a day in interest payments. The numbers came in on our deficit this year. It's about $2 trillion. That's more than $2 trillion more than we're bringing in, right? We're spending. That's a real problem.
And much more than had been anticipated.
Voters. Yes, yeah. Exactly.
Wow. Into a 5% GDP in Q3.
Exactly.
It's not like we're trying to spend ourselves out of a recession here. I mean, this economy is on fire.
And fuego.
Yeah.
So, Jen, is there any reason to believe that this new speaker will have any more success than the prior speaker in terms of dealing with the extreme right in the party, whether it's those 6, 7 people, whoever they are?
He's just dealing with himself.
Yeah.
Yeah, that's a $64,000 question, right? I mean, this member has only ever had to speak for himself and for his constituencies in Louisiana. He has held a leadership position in the sense he was vice chair prior to the speakership. So he's been at the leadership table. He's heard the strategy. He's been part of that discussion. So he's coming in with some context, some awareness, and he certainly had to understand the factions and what he needed to do in order to bring together the members of this conference in order to get to the speakership. I think going forward, he has suggested in his run for speakership earlier this week with the conference, he has suggested that he wants to pass a CR into January or April 15th, which is another magic deadline as regards to budget, in order to get that leverage for Republicans in the House to really negotiate with the Senate. This is going to be his first test. This will be key to show whether or not he can bring this conference together.
All right, Jen, thank you so much for joining us. Really appreciate getting your insight. Jennifer Flitton, head of U.S. Government Affairs for Invesco. Before joining Invesco, she spent a lot of time in Congress as working for actually a Congressman Patrick McHenry in his office, so lots of experience there.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, here's some economics for you. We had the GDP print today, Matt, right? 4.9%. Things
Strong.
are great.
Yeah.
But then you go look ahead, and you see a company like United Parcel Service. These folks, they see the economy every single day on the ground. They put up disappointing numbers, cut the forecast again. To me, that's the number to be focused on.
I mean, you don't even have to look ahead, right? They did cut their outlook for the second time in less than 3 months. But even backward looking, it was horrible. Annual EPS came in at $1.57, down 47% from a year ago.
Well, they got to pay their pilots more now, right? Didn't they have that new contract?
I don't know.
Let's bring in somebody who knows about this stuff.
Yeah.
Lee Klaskow, he covers all the transportation stuff. We blamed him for the supply chain thing back a couple of years ago. Now he's
got it
fixed
back
that.
together. Yeah.
He's with Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio. Hey, Lee, what did you really hear from UPS and their earnings and kind of their outlook?
Well, I mean, at the end of the day, they had a tough slog with their labor negotiation. They lost a lot of business to FedEx and other carriers. They're in the process of winning that business back. They've won probably around 600,000 packages per day back of what they lost. And it's going to take some time for them to get it all back. The good news is that some of the sequential changes that they saw from August to October, which August was the hardest hit from that labor agreement in terms of volumes going away. They're seeing seasonal trends well above what they normally see. They said that volume during that time period sequentially was up around 2.7 million packages a day, and last year that was around 1.5 million packages a day. So it's definitely they're definitely turning in the right direction, but the streets got to readjust their models. Fourth quarter expectations are definitely going to have to come in. They provide full year guidance, which, as you mentioned, they had to lower it again. But when you look at the implied, what that means for the fourth quarter earnings expectations and the EPS basis are going to have to come down anywhere between 25 and 30 cents.
Well, you care about UPS for the sake of UPS and their competition. We care about it mostly, I would say, for their view on the economy, right? Because if things are going well, we're going to be shipping packages back and forth. If they're losing out to competitors, that's one thing. But if they have a dour outlook because they expect the economy to slow, that's another. Which is it?
Yeah, I think UPS is obviously a bellwether for the global economy. They have businesses everywhere around the world. They ship everything you can imagine and probably things you can't imagine. But I think
I would love to hear the top 10 craziest things UPS shipped.
Yeah.
Why don't we do a top 10 list ever, Paul?
Yeah, that's a good idea.
We should do
that
that.
hasn't been done before.
Yeah. Well,
Okay.
I mean, anyhow.
I think the weakness that you're seeing in the fourth quarter, about a third of it is probably macro driven and 2/3 of it is UPS specific.
Excellent. That's exactly what I was wondering. So 2/3 of it is company specific or industry specific, and a third of it is the economy.
Yeah, because I mean they're really dealing with the lost share that they had, and when you have these huge networks, there's a deleveraging effect, right? So the less density you have, the more expensive it is per package.
So how do you win back business? Just on price?
Price, service. The company during their call was very adamant about the fact that they are not using price to entice people back. Maybe they're giving a slight discount, but they're not going into a deep discount because at the end of the day, they have to pay for that new labor agreement. It's a 5-year deal. A lot of it it's front loaded. Something like 48% of it is in the first year. So they need to really offset that cost, and that's going to be a headwind for them going through the first half of next year.
How does their labor cost look compared to others? And the reason I'm asking is, you mentioned service, right? They're going to deliver better service if their employees are better paid and in less stressful working conditions, have air conditioning in their trucks or heating in the winter. Are they in a good setup in that way?
When you look at UPS and you look at FedEx, there are two different models. FedEx has the independent contractor model. Even if you look at Amazon has an independent contract model. What it benefits UPS is they have stability in their workforce. They have a place where people probably want to come because they're making more. And not only maybe they're not making so much more from a dollar standpoint, but when it's all said and done, with benefits, pension, all that stuff, it's a place where people not only want to work, but they probably want to work their whole careers versus a FedEx or an Amazon, where the employees are it's really a transaction, if you will. They're just there for the paycheck, and if they find something better, they're off to the highest bidder.
To me, as a customer, I would rather than use UPS.
Yeah, you get a relationship with your delivery guy or gal. Yeah.
And
That's
they have a cool
cool
uniform.
Yeah.
I like the brown.
So are we going to put air conditioning in the trucks now?
They're putting fans, air conditioning, all that sort of stuff.
Why didn't they in the past?
They just, you see them on the road. They
just
open the doors, and listen, it's at the end of the day.
These guys are down in Texas where it's like 300 degrees out. I mean, I don't care how many doors
now
you
they're
got
changing it.
They're changing.
I mean,
They're
they didn't
evolving.
expect global warming to happen like this. Nobody told them it was going to happen like this. Who knew?
Exactly. All right, Lee, let's step back a little bit from UPS, just kind of your space in general. You do, the big ocean shipping container, the railroads, the trucks, everything in between. Talk to us about just how is it out there in the transportation space? Are your companies seeing a slowdown? And if so, how pronounced?
Well, we've been in a freight recession for over a year now.
Now, was it just tough comps?
Tough comps. There were certain aspects of the market that were down a lot more. What we're seeing now is that, the freight recovery will probably lead the economic recovery. And the freight recession should probably come near to an end in the first quarter because of easier comps.
Okay.
Assuming we have some sort of GDP growth. It doesn't have to be stellar growth. It could be low single-digit growth. Assuming that's the case, we should come out of this funk. And what this done is really depressed rates across the board. So if you're looking at trucking rates, liner rates, they are very, 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 very low. And it's, for some of these markets, especially trucking and the container liner market, it's really hard to figure out what's going to bring rates up because there's a lot of downward pressure because there's just so much supply out there.
Why is there supply?
Well, on the ocean liner.
Oh, okay.
On the ocean
everybody
liner
wanted
aspect,
capacity, right? Everybody expanded.
People are buying capacity. Capacity growth is expected to outpace demand growth by something like 500 to 600 basis points this year and next year. And then you have rates that were, they're down like 70% from a year ago.
Now, if you wanted to ship your car
now's the
no
time.
problem.
Now, yeah, but I had to sell it.
Yes,
It's
exactly.
it's a depressing story.
And if you wait, if you want to wait, you probably get an even better rate because liner rates, there's really no net for liner rates right now. Wow. Trucking is a different story. Supply is coming out of the market, which should bode well for truck rates.
All right, Lee, great stuff. As always, Lee Klaskow, he is a senior transportation analyst, logistics, all that good stuff for Bloomberg Intelligence, based down in Princeton University, been making his way here to New York. We appreciate that.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I tell you, here's the story that's got my attention over the past couple of days. This is going to be fascinating. Sam Bankman-Fried, he's going to testify in his trial on his own behalf to try to, counteract some of the negative testimony from some of his former colleagues and friends and girlfriends. I don't know what's going on there, but Max Chafkin, he knows. He's a columnist for Bloomberg Businessweek. Max, this sounds really risky from my perspective. What do you make of it?
Well, so, as you say, and as you're hinting at, criminal defense attorneys generally do not advise their clients to testify in their own defense, especially in a case like this. Sam Bankman-Fried, though, is not a traditional client. And as we know, anyone who's followed this story knows that he spent a lot of the weeks after the fall of FTX, and even after his own arrest, giving interviews, talking to pretty much anyone under the sun, saying all kinds of sort of half-cocked, probably legally ill-advised things, including that he, effed up. And I'm quoting there. And so again, this is not a traditional client, and we're probably not going to see a traditional defense or traditional testimony from him.
What have we seen so far? I mean, has the testimony been so damning that putting himself on the stand, or that a lawyer putting him on the stand, is the best the defense team can do?
I mean, I think, again, I'm not on the jury, and so it's always hard to speculate, but it has seemed from the outside to be pretty damning. I mean, we've seen basically his closest friends and senior executive team all get up there on the stand and talk, not just in detail saying that, yes, the crimes that the state is charging did occur, Sam Bankman-Fried did them, but producing essentially mountains of evidence showing Bankman-Fried's direct involvement. So we've seen messages, we've seen Google Docs, we've seen these very specific accounts, particularly from Caroline Ellison, who was the CEO of Alameda Research, that was Bankman-Fried's hedge fund, and his ex-girlfriend. They produced this kind of chain of balance sheets that Sam Bankman-Fried was very active in. So, it has not looked good for the defense.
What has been his, I guess, defense in this? What's he claiming, or I don't know.
Well, he already told us he effed up.
There are aspects of the defense that look like a traditional white-collar defense. A lot of times in white-collar defenses, what the person who's accused will try to do is present as very complicated. There's a lot of ins, a lot of outs. This is, complicated stuff, and I was doing my best, didn't mean to commit fraud. There is some of that here, but there's also been an effort to essentially blame everybody other than him. And that's the part that I'd say is probably legally, less well advised. He spent a lot of time in interviews ahead of this. We've seen some of this come out during the trial, essentially blaming Caroline Ellison for the fraud, or blaming his lawyers, or blaming, outside counsel, and so on. And again, it hasn't seemed especially credible because the prosecutors have been able to produce, emails and so on showing that he was very involved. And also, it's not exactly a good look when the CEO is saying, oh, no, this is just my underling's fault, especially the CEO who at one time, had personally enriched himself to the extent that Sam Bankman-Fried had done so. We've learned of $1 billion in personal loans, $300 million in luxury real estate, and the list kind of goes on and on.
Is there any chance, and I don't know that this matters in terms of this current court decision, but is there a chance that people who lost money in FTX are made whole because of, moonshot investments that they made that now look like they may pay off?
Yeah, I mean, I think it's definitely too soon to say made whole. I think it's looking increasingly likely that some money, at least, will be recovered. I think you're alluding to Anthropic, which was this kind of moonshot AI investment. Is now, there are rumors, valuations being tossed around in the tens of billions of dollars. The issue is that there's a lot of these assets are not highly traded. So it's sort of hard to know, like, if they started selling them, what would happen to the price, where would they go? And even with a case of Anthropic, right, you can't just go and sell that stake on the open market. A lot of this stuff will take a long time to unwind. The economy can change, and so on. The other thing is, the question of whether or not investors can be made whole isn't really relevant to Sam Bankman-Fried's
It's not relevant, but
yeah.
I mean, Matt Levine has written about if you defraud somebody and that person never gets her money back, you're going to be in trouble. But if you defraud someone and she does get her money back, it's going to be less bad, right?
Yeah, and perhaps that'll impact how Sam Bankman-Fried's legacy, is perceived and so on. I don't think it's going to have an impact on this case because, again, the jury isn't hearing this stuff. And again, the charges are, did Sam Bankman-Fried take customer money and gamble it? The fact that you gambled it and maybe won doesn't necessarily, address the central allegation. And again, there are other allegations here. That, we're going to have a second trial around campaign finance violations. That stuff can, he could go to jail for a long time. There's the Chinese bribery allegations. So there's a bunch of...
These are separate trials?
There are two separate trials, yes.
So what's the timeline look like for this one?
So we're going to see Bankman-Fried likely start testifying today. That'll go into tomorrow, probably early next week. I mean, the jury could begin deliberating next week. We could have a verdict as early as next week, although it seems possible it could go on to the.
Are reporters allowed in the courtroom?
Yes.
Okay.
The public is allowed in the courtroom. We have a team of people down there. They've been reporting on this, relentlessly. You can read it on Bloomberg.com at the terminal. General public's also in there. So we've seen kind of a weird rotating list of kind of crypto figures and influencers. I think Martin Shkreli was down there early on. It's sort of been a kind of weird reality show.
Because I mean, this really, to a certain extent, I wonder, crypto, to what extent is this an indictment or of the crypto space? I mean, is it seen that way by people?
Well, I think it depends who you talk to. So you talk to people in the industry, right? They have been very keen, and you've seen the industry really, they have been some of the most aggressive people in calling out Sam Bankman-Fried because they want to make an effort to say, hey, look, this was a bad actor, bad apple. He's making us look bad. I think in the minds of normal investors, in the minds of the public, right, that argument's a little harder because Sam Bankman-Fried, his whole thing was that he was the most law-abiding, least sketchy. I mean, this is a world that has operated kind of on the edges of various laws in all over the world. So again, I think it's really too early to know what the impact is going to be on crypto broadly. And I think some of that has to do with, frankly, the verdict. And depending on what the jury says, I think will affect how people process this.
Dude, you got to think that, just because Bernie Madoff committed a big $65 billion fraud with an investment Ponzi scheme, that's not an indictment of the U.S. stock market and certainly not of the U.S. dollar, right?
Right, exactly.
Although I could see that because crypto is so difficult to understand and because it's not clear yet whether much or even any of these coins are going to be worth something in 5 or 10 years, people might very easily conflate the two.
Yeah, absolutely. I mean, it was an indictment of Ponzi schemes, right? And the crypto critics are gonna essentially say that there are businesses out there that are operating in ways that aren't necessarily that different from the way FTX was operating.
And this guy's facing real jail time, right? What is it?
I mean, he faces a potential life sentence.
Wow.
Effective life sentence.
Yes.
It's going to be so many years that it would be, he would be old or deceased by the time he got out. We don't really know. Of course, there's a wide potential range of potential sentences. You're talking about anywhere from years to decades, and of course he could be acquitted. Whatever happens with this case, I think there are definitely going to be appeals, and there is this second trial, the second criminal trial, which also carries significant jail time.
All right, man. Great stuff. Max, thanks for joining us here. Max Chafkin, he's a columnist for Bloomberg Businessweek.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.